Welcome, curious minds, to another compelling deep dive. Today, we're really pulling back the curtain on one of the most talked about concepts in price action, the fair value gap, or FVG.
Yeah, often talked about, but maybe not always fully understood.
Exactly. So our mission today, to demystify it, we want to distill ICT's teachings into five essential actionable rules for understanding and using these signals.
And we're drawing this directly from the source materials you've all been looking at.
Right. Get ready for some, hopefully, aha moments, because this isn't just spotting patterns, is it?
No, not at all. It's about trying to see the market's, true intent, how the algorithms might be operating underneath. And it's true, while loads of traders discuss FVGs, few really grasp their application in revealing market mechanics.
Yeah.
So this deep dive, it's aiming to cut through some of that noise, give you a shortcut maybe to being well-informed about this pivotal concept.
Giving us the keys, essentially.
Kind of, keys to a crucial aspect of anticipating how the market might move.
Okay, let's unpack this then. Rule number one. Fair value gaps are basically market inefficiencies. But hang on, before we get technical, what's a common mistake people make right off the bat? What's the biggest misconception about what an FVG is?
That's a really good place to start. A lot of people, they just think an FVG is, any old gap in price they see on a chart.
Right, just a space.
Yeah, but it's not that simple. An FVG is quite specific. It's an area where the order flow, it's left a distinct imbalance. It signals a kind of void that the algorithm often seeks to reprice. Like ICT puts it, the bearish ICT fair value gap. This is institutional order flow, and it's a pattern that you can see the order flow actually coming into the marketplace.
Ah, okay. Institutional order flow.
Exactly. And visually, it's that specific three-candle formation, where the middle candle's range isn't fully overlapped by the wicks of the candles on either side. These are described as actual inefficiencies, indicating order flow. They can act like price magnets, revealing algorithmic intent. So the idea is the market doesn't like spending a lot of time there. It's an imbalance it wants to correct, often.
Okay. Distinct from a liquidity void, which is like a complete absence of trading.
Precisely. That's a different thing altogether.
So for you, the listener, what's the real benefit of spotting these? How does understanding this kind of hidden language help anticipate market direction?
Well, what's really insightful is realizing these aren't just random. They're almost like the market's accounting ledger, showing where orders were filled so aggressively that price just shot through. Understanding that means you're not just reacting, you're anticipating the algorithm potentially coming back to sort of balance the books. It's a fundamentally different perspective.
That makes sense. But you mentioned pitfalls earlier.
Yeah, a big one is trading every FVG in isolation, just seeing one and jumping in.
Right.
And misinterpreting their role. Or, another common mistake, assuming they will always fill.
They don't have to fill completely.
Yeah. No, not guaranteed. And they definitely shouldn't be traded without that wider context.
Understood. That clears things up nicely. And that wider context leads us straight into rule number two. Always confirm market bias before trading an FVG. We've all seen those tempting setups. Why can't you just trade any FVG you spot? What's the risk?
The risk is pretty significant, actually, because if you don't confirm the market's main story, is it bullish, is it bearish for the session or the period you're looking at, you're basically swimming against the current.
Against the institutional flow.
Exactly. ICT warns about this explicitly. He says, the bias is bearish. So if the bias is bearish, would you go in looking for a bullish fair value gap? No, that's the purpose of having a model.
So going against the bias is just low probability.
Very low probability. Your FVG setup, it has to align with the market's perceived true direction. You need that baseline on what the higher time frame daily chart is doing, and you need to anticipate its likely expansion.
And this involves things like the power of three.
Often, yes. That cycle. Accumulation, manipulation, and then distribution. Understanding that pattern is key for anticipating the daily bias.
Accumulation is gathering positions. Manipulation might be a fake-out move.
Right, to trap traders. And distribution is the real intended move where smart money might be taking profits or initiating the main leg.
So ignoring all that leads to the pitfall of trading against bias.
Correct.
So how does nailing this bias help you filter trades? Does it help you avoid chasing those setups that just aren't likely to work out? It sounds like a critical filter.
It really is the primary filter. By aligning your FVG trades with that underlying bias, you automatically weed out so many low probability scenarios.
Even if they look good on the chart.
Even if they look visually perfect, you stop just reacting to a pattern and start understanding its significance within the bigger picture. You're not just trading an FVG, you're trading with the market's institutional intention for that period. It forces discipline.
Saves time, saves capital.
Definitely. Stops you wasting ammo on setups that probably lack that institutional backing.
Which brings us neatly to rule number 3. Always anchor your FVG analysis to higher time frame context. Prices move fast, especially on, say, the 1-minute chart. Does this mean you really shouldn't just stare at that 1-minute chart alone?
Absolutely not. Honestly, relying only on those very low time frames, it's often a recipe for frustration. Lower time frame FVGs, they gain significant reliability when you see them forming within the context of the daily or hourly price action.
Okay.
Without that bigger picture, you're just reacting to noise, aren't you? There's no real strategic foresight. As ICT emphasizes, you got to look at the higher time frame. The higher time frame, 15-minute time frame, is providing you the framework. It's giving you context.
Context is key.
It is. And remember, the daily chart, that's exactly what institutions are working off of. That's exactly what banks are working off of. That's where the money is. That's where your bias is going to be determined.
So you're working with the tide.
Exactly. You want to be moving with the ebb and flow of these markets on a high time frame.
Yeah.
It's like you wouldn't try to navigate a cross-country trip using just a map of your local town, would you?
No, definitely not. I like that analogy. It really provides that crucial roadmap. Helps you see the forest, not just the individual trees. So what's the real tangible difference this makes when you're actually about to place a trade?
Well, it's the difference between just guessing and actually strategizing. The higher time frames show the general direction, the key levels.
The narrative.
Right. And then the lower time frames help you pinpoint precise entries within that narrative using FVGs maybe as your trigger. That context, it elevates your analysis. It stops you from, say, taking a short on a 1-minute chart right when the daily chart is screaming major bull trend starting.
Got it. Big picture first. Okay, on to rule number 4, which is all about timing. Prioritize FVGs that form or are engaged within specific time windows. These are often called kill zones or macros. So, are there specific times of day you should be really paying attention for these FVG opportunities, not just watching all day?
Oh, absolutely. The market's algorithmic delivery seems to be highly time sensitive. Certain periods, these kill zones or macros, they are considered high probability times for significant moves.
Why is that?
Usually because they align with major market opens, institutional order flow coming in, or times when liquidity is often engineered or swept. For instance, within the silver bullet framework, which is about specific high probability FVG setups, ICT points out windows like 10:00 to 11 o'clock New York local time. And also our last ICT silver bullet here, which is framed on 2 p.m. to 3 p.m. New York local time.
Okay, specific hours.
Yes. And then you have the broader kill zones, the London kill zone, typically between 2 o'clock and 4 o'clock in the morning, or more broadly 2 a.m. to 5 a.m. And crucially, that's relative to New York time.
New York time is the key reference.
Always. The classic New York kill zone is 7 a.m. to 9 a.m. New York time. Then there's the London close kill zone, 10 a.m. to noon New York time.
So these are like prime hunting times for the algorithm, when the market structure is more likely to give clear signals.
That's a good way to put it. Aligning your FVG entries with these specific moments can significantly increase your edge. And also really important is the midnight New York opening price. That's seen as a crucial daily reference point.
How so?
Well, the idea is if you're bullish for the day, you'd preferably want to be buying below that midnight opening price. If bearish, selling above it.
Makes sense. And the warning about chart time.
Yes, critical. If you don't set your trading view chart or whatever platform you use to New York time, ICT warns, you're going to mess up. You won't have the same calibrations. Everything is based off that NY time.
Got it. And any time to avoid.
Yeah, generally the noon to 1.0 in the afternoon New York time period. That's often seen as a sort of lunchtime lull, lower liquidity, less reliable moves.
Okay, so how does knowing these specific windows help you, the listener? How does it help focus attention and avoid just staring blankly at charts for hours?
It lets you be incredibly efficient. Instead of feeling like you have to scan charts constantly, you know when the high probability moments are likely to occur.
So you can step away.
Exactly. We've all been there, right? Glued to the screen all day. But understanding these windows helps preserve your mental energy, prevents overtrading. You focus your attention when the algorithmic delivery is typically most active and potentially more predictable. quality over quantity of screen time.
Right. And that brings us to the fifth, final, and maybe the most crucial rule for really mastering this. Diligent journaling and backtesting are essential. Now, why is journaling so vital? If you're watching videos, learning the examples, you feel like you understand the theory. Why isn't that enough?
Because theory needs to become practical, repeatable skill. It needs to get into your bones, almost, as ICT puts it quite profoundly. You're going to spend the rest of your career doing this very thing if you want to run it like a business. If you want to be extremely precise, detail-oriented, consistent, this is how you get it.
Wow. Okay, so it's about making it a business process.
Yeah, precisely. The purpose is to train your subconscious mind, build your own library of experience, and really internalize these algorithmic signatures. You have to document price action, log examples with your own annotations for your study journal.
Your own notes, your own observations.
Yes. And weekend study is highlighted as critical time to study how each one of these work together to complement one another. ICT even suggests actively trying to disprove the concepts. Go into the charts and look for this not being true.
Try and break it.
Yeah, because that process of trying to find where it doesn't work paradoxically strengthens your understanding of when and why it does. It builds what's called pseudo-experience to train your brain.
So it's really about taking that borrowed knowledge and making it deeply yours, like building your own mental database of market behavior you can access instantly.
Exactly that. It builds confidence, it builds precision. These are intangible but absolutely invaluable in trading. The big mistakes here are rushing to live funds before you've done this work and just relying on hindsight after the fact. The core philosophy, as ICT mentions, is fostering independence. That way you're not requiring any hand-holding by me.
You have to do the work yourself.
You have to, and you need to write it down. Sometimes the best rules are the ones that help you stay out of the marketplace. Journaling helps define those rules for yourself. This whole process, it conditions your subconscious. It's like training your brain to recognize these patterns and react appropriately, almost instinctively, in real time, like muscle memory for a trader.
That really drives home the power of personal effort, doesn't it? Journaling and backtesting aren't just review. They genuinely transform understanding into personal insight. It lets you act with confidence, but maybe just as importantly, know when not to act.
Absolutely. So, there we have it. 5. Let's call them immutable rules for approaching fair value gaps. Identify the true inefficiencies.
Confirm that market bias.
Anchor your analysis in higher time frames.
Respect those specific time windows, the kill zones.
And commit, really commit, to diligent journaling and backtesting. If you can commit these 5 rules to memory, apply them rigorously, well, you should see your understanding of the market start to transform. And for those wanting to continue their education and find more verified ICT content, you can visit https://getchytrades.com/landing.
So, maybe leave you with this thought. Consider how these insights into algorithmic intent might really shift your perception, moving you from being just a passive reactor chasing candles to an active observer anticipating the market's potential next move. Until next time, everyone, be disciplined, be patient, and trade smart.